So let's start with the CPI numbers. You saw what the markets have made out of it. They liked it a lot because they thought maybe inflation is coming down. What did you make out of those numbers?
So the worst fears were allayed. I mean, it wasn't that far from expectations. You know, the markets can tend to parse a couple of hundredths of basis point or a basis point to determine like it's better or worse. There were some things that were better there that were encouraging, including you start to see some of the transportation services come down, rent started to come down a bit. So there's some encouraging things. It was pretty much on expectation, but there was a fear because we've had 3 months in a row of high numbers that maybe we're moving to a more normal, more stable environment. And by the way, it was contiguous to retail sales that were softer. Some of what you've seen play out in these earnings reports, there's definitely some consumer pullback. So the combination of and PPI not being that bad, some stability, and then, gosh, you're seeing some softness show up that you've got a Federal Reserve that already raised the bar of hiking rates, but now you can start to think, can you get a cut or two done this year? And I think that emboldened that thesis.
Some of us in the media have a tendency to look at a number, how much is up or down. There are a lot of things under that number. Address one thing I've been curious about, goods versus services, because there's a different trend there on inflation. From the Fed's point of view, do they need both goods and services to come down? Because the one is coming down, the other not so fast.
So it's pretty remarkable. We're moving to a service-oriented economy. More money's being spent on services. But it's actually what's happening because goods prices have come down so much. It's allowing for disposable income to go into services. That's actually buoying prices in services, ironically. I've said this over time, and I've used a bunch of examples, like a price of a pair of tennis shoes is what it was 20 years ago. If you go to a tennis match, it's double what it used to be. So meaning services, goods come down, services, think about in autos, price of autos on a relative basis. So what's happening for the Fed, listen, you want to get the average, you want to get inflation down to around the 2% number. Their mandate is price stability, it's not 2. If you're running 2.5, core PCE is now 2.8, but it's pretty stable. We think it'll be pretty stable throughout the year. If you've got a good economy, nominal GDP, so if you take 2.8, of inflation, you get real GDP of 2, you got nominal GDP of 4.5 to 5. Pretty good. I mean, it's a pretty good environment.
Some people have been surprised, I think, that the economy has not reacted faster to 500 basis points in interest rate increases. Some of that is because you can term out the debt, as some people do. And one of the things that we've seen recently is a difference for households between what they owe on their mortgage, which is a longer-term thing, and the shorter-term debt, such as credit cards and auto payments.
So, Sen, I'm not certain that raising interest rates actually brings down inflation. In fact, I would lay out an argument that if you cut interest rates, you'd bring down inflation. Why is that? Exactly to your point. Look at what's happening now. Interest expense is growing, has now eclipsed mortgage payments. Lower income, who much higher percentage of their net worth is in the debt, credit cards, student loans, auto finance, et cetera. What's happened is you've raised the rate, and that has created a real impact. And so, but the other side of it is you actually have an economy because of this massive transfer from the public sector, from the government to the private sector. People at higher income, middle to higher income, are now getting a big benefit from these interest rates. And that's flowing into, those are the people that spend in aggregate on services. So there's an ironic thing that I've never seen, nobody's ever seen in history. Big transfer of money from the government into the private sector. The private sector now is a creditor versus a debtor in terms of the big pocket of wealth. It's what's happening, those lower income. So there's the chart we show around, look at restaurants. High-end restaurants killing it. Low-end restaurants or low income having a really tough time. You saw it in all the earnings in this last quarter. Really big deal today. And then the other side of it is not only is lower income getting hurt, not only is small business getting hurt, local banks getting hurt, and it's part of why I think they need to bring the rate down. But you look at companies today. Normally, when you raise the interest rate, companies, pull back. Companies term their debt out because we went through not only a transfer of money from the government to the private sector, we kept interest rates down for so long. 70% of the high yield market termed their debt out when the funds rate was under 1. They have no debt coming. They have no real maturity wall. So think about what the interest rate does. You raise it, doesn't really matter for companies. In fact, companies are sitting on a lot of cash, so they're actually getting the benefit of higher rates. So point being, I think the Federal Reserve can get that rate down from 5 3/8. Even if you got it to 4, 4.5, still restrictive relative to a 2.8 core PCE. And it's not clear to me, you've raised rates 500 basis points. Does it really impact inflation? And I would argue at a certain level, it actually maybe is actually helping keep inflation high because we've never seen this in history because of those other influences.
So you think it's possible if they cut rates, it actually might deter inflation rather than spur it on?
By the way, I'll throw one other thing. There's been an aging of the population that we've never seen before, and a wealth creation at the higher end. It's actually, if you break down the demographic today, there's been an incredible growth of the savings and the spending from older people at 55 and above. It's fascinating what's happening. By the way, if you keep the real rate high, huge benefit to those people. They're turning around spending. So why is inflation high in things like health insurance? Why is inflation high in a number of these service sectors, auto insurance, et cetera? They're sticky, they're unresponsive to interest rates, and people are spending. Older people, middle to high income, are spending and are keeping that service level inflation at high levels.
Is it a good thing for fixed income investors right now? Is the timing good right now?
So I would say I don't think rates are going to come, we're going to have this incredible rate drop of any time soon. I do think the world is in more of an easing cycle. You look at, obviously, in Europe, UK moving faster, emerging markets, many countries moving. So Argentina just dropped the rate in a radical way. So that is healthy, but there's something in fixed income that I think is extremely unique. You can create income. For years, decades, we were sitting at rates were at zero. You had to buy dicey emerging markets. You had to buy dicey parts of the high yield market. Today, you can create a 6.5%, 7% yield. And so what you're seeing is people like, gosh, if you can get me 6.5 without a lot of volatility, I own equities, I get volatility there, I'm okay with it. Get me my fixed income, get me a lot of yields without the same volatility. That's a pretty unique point in time. I've said it's the golden era of fixed income, not because rates are going to come down, but you can build a lot of yield in the portfolios.
So explain something to me I don't understand as a fixed income investor. In a marketplace, normally, if that's true, a lot of money will crowd into fixed income, and that should drive the rates down, actually, right? So you don't get as much out of them. Why isn't the market actually taking a lot of that benefit out of the investment in fixed income?
So it's a great question. So there's two things happening. One, U.S. government has a huge amount of debt they've got to keep issuing. I mean, I've said that $400 billion a week of bills, $100 billion a week on average of coupon issuance from the government. So there's a ton of money that's coming in. You've got a Federal Reserve that's keeping the front end of the curve, I would argue, too high today, but high today. So those are obviously keeping the yields where they are. Companies should be borrowing 200 to 300 basis points lower yield. Given what we talked about, their credit quality is superb today. They're not, because service level inflation is high. The Fed keeps the rate high, and so as an investor or anybody today who gets to be a lender, you're getting to buy credit assets a couple hundred basis points cheaper than you really should. Even though the spreads are tight, it's just because the risk-free rate, because given how much where treasuries are, it's so high today.
One last one on the investment front, and that is the first thing you talked about, the demand from the Treasury. They have to borrow a lot of money. We hear increasingly from a wide range of sources, Ray Dalio, Jamie Dimon, everyone talks about the fact that we are really borrowing a lot of money, and sooner or later there's going to be a problem. We talked to Paul Ryan, somebody you know well, last week, who said he thinks it's not at all unlikely that the next president, whoever it is, will face perhaps a real debt crisis in the form of a failed Treasury auction. Do you see that on the horizon?
So those are all smart people. Can I just say agree? And I think the debt's too big, and I think we're not going to address the size of the debt in the country today. And I think over the next year or two, I think you'll see auctions, 30-year auctions, that'll have a hard time clearing the market. It's too much debt. At the same point in time, most countries, and you think about China, Japan, they have alternatives. They're funding more domestic priorities versus the United States debt. And so I think we have to be pretty careful about that. There's a lot of debt coming. There'll be a point in time, if the Fed is moving towards lowering rates, you feel better about we'll be able to fund it. People are comfortable coming in. I'm not going to lose money. There's going to be a point in time where rates will move up again, and people say, I don't want it. Who's going to fund it? And so I think what will happen is more will have to go on the Fed's balance sheet again. Think about Japan, what happened to the currency. Listen, I think we got to be careful about it. I think policymakers are going to need to address it over the next couple of years.